Hey everyone, welcome back. So, if you're the kind of person who really loves getting into the weeds and understanding the actual inner workings of complex deals, well, you are definitely in the right place. Today's explainer is all about taking a deep dive into the hidden, highly strategic brokerage work that happens entirely behind the scenes of a commercial real estate transaction. When we see a sold sign pop up on an apartment building, we're really only seeing the end result. What we don't see is all the tactical maneuvering, the sudden crisis management, or the strategic pivots it actually takes to get that deal across the finish line. So today, we're going to unpack this really fascinating case study from Cascade Commercial, looking at a specific property in Lincoln, Nebraska. To do this, we're going to use an iceberg model to structure our breakdown today. We'll quickly look at 1. The 1621 G Street asset itself, then dive into 2. Economic headwinds and challenges, 3. Gatekeeping and lead management, 4. Bridging the appraisal gap, 5. Mastering municipal compliance, and finally, 6. The art of the close. Section 1. The 1621 G Street asset. Let's start right at the top, above the waterline, just to get a feel for the physical reality of the property. All right, so here is the very tip of our iceberg. This is 1621 G Street. It's a built-for-purpose 10-unit apartment building sitting right in a highly prestigious submarket of central Lincoln. Built back in 1966, it's got a really well-maintained brick exterior, secured entry, private parking, the whole shebang. But what makes this asset an absolute standout is its strategic value. I mean, it literally sits just one single block from the Nebraska state capitol. That is a location that practically guarantees steady foot traffic and incredible visibility. Stepping inside, the property is made up of 4 studio apartments and 6 one-bedroom, one-bathroom units. And because of its footprint and that prime proximity to downtown, it enjoys this really sustained demand. We're talking government workers, legislative staff, young professionals, people who basically want quality housing just a stone's throw from the office so they don't have to deal with a harrowing commute. So it's a very stable, income-producing asset, but as we're about to see, even a great building doesn't just magically sell itself. Let's anchor ourselves in the financial baseline that the sellers and brokers were initially working with. They went in with a starting asking price of $775,000. Now, against that target price, the property was already generating a really solid actual net operating income, or NOI, of $61,450. And the gross potential rent was modeled out at $83,220. So purely on paper, these are very, very healthy numbers for a 10-unit building of this vintage. And to really ground those financials in the local reality, we have to look at the specific demographic data of this submarket. The median contract rent right here is $773, which is actually about 18% lower than the state average for Nebraska. And the median household income is sitting right around $39,400, with a heavily white-collar workforce at over 54%. Now, why does this matter? Well, this data is absolutely crucial because it strictly defines the buy box for potential investors. They need to know the tenant base is stable, but they also have to understand exactly where the ceiling is for rent growth. But as solid as these numbers looked, they were about to hit a brick wall. Which brings us to Section 2, Economic Headwinds and Challenges. Now we are shifting below the waterline, because the macroeconomic environment during this specific sale was just brutal. Selling this 10-unit building was by no means a guaranteed thing. The seller was trying to exit this legacy portfolio asset during a really daunting economic window. We're talking about a market plagued by sticky inflation, a totally flat Federal Reserve policy keeping interest rates stubbornly elevated, and super conservative lender sentiment. Banks were nervous, which meant buyers were sweating. The cost of capital was extraordinarily high, and that meant the margin for error on a $775,000 acquisition was razor thin. Literally one wrong move and the whole deal just falls apart. Section 3, Gatekeeping and Lead Management. This is the first major pillar of unseen work where Cascade Commercial really had to step in and act as a shield. Cascade basically became a very strict bouncer at the door. Step 1 was all about keeping a detailed tracking system to categorize every single contact. Step 2, monitoring real-time buyer behavior. Like, are these folks just kicking tires, or do they actually have the real capacity to close in a tough market? Step 3 is where the magic really happens. Actively disqualifying groups who have weak capital stacks or lack the experience needed. Why? To avoid the dreaded retrade. If you've been in this industry, you know the absolute nightmare of a retrade, where a buyer gets you all the way to the altar and then suddenly tries to slash the price right before closing. So to completely avoid that, they executed Step 4, which was presenting only a highly curated, fully vetted shortlist of serious candidates directly to the seller. No time wasted. Section 4. Bridging the appraisal gap. All right, so once they actually found the right buyer, they hit a massive hurdle, one that kills countless commercial deals every single day. Notice the strategic pivot here. That initial $775,000 pricing pushed the absolute upper edge of the market. And early feedback was making it pretty clear that it was just too far ahead of where conservative underwriters felt comfortable. But instead of stubbornly digging their heels in and watching the deal die, Cascade went out, gathered real-time market feedback, sat down with the seller, and walked through the comparable sales in detail. Then they made a highly tactical price adjustment. They aligned it perfectly with recent nearby sales while still honoring the high quality of the property. It was a really calculated, absolutely necessary move to keep the momentum alive. But here's the thing. Just adjusting the price wasn't going to cut it. They still had to convince the bank's finicky appraiser. And in an environment where deals are routinely stalling out right at the appraiser's desk, these brokers got proactive. They build what they call an appraisal bridge package. They didn't just hand over the keys and say, good luck. No way. They compiled undeniable evidence, trailing 12-month financials, a spotless current rent roll, hard proof of recent renovations, and a really compelling story about the building's occupancy. They literally spoon-fed the appraiser the exact narrative and data needed to justify the valuation, just a masterful stroke of risk mitigation. Section 5. Mastering municipal compliance. Now, if you have ever dealt with real estate, you know that the local regulatory landscape can be an absolute minefield. I love this quote from the case study. In a choppy, high-scrutiny market, that quiet coordination work was a key factor in converting an accepted offer into a closed transaction. And it's so true. Lincoln's multifamily landscape demands serious municipal involvement. Anyone who spent time waiting on a city inspector knows the pain we're talking about here. But Cascade acted as the central nervous system for this whole deal. They coordinated between the city inspectors, the existing property management, and the buyer's inspection teams. They expertly managed unit access, clearly separated routine inspection items from actual material issues, and knocked down potential roadblocks in days instead of weeks. And the best part? The seller didn't have to deal with a single stressful email about compliance. That quiet coordination handled the whole thing right behind the scenes. Section 6. The art of the close. All right, this brings us all the way back above the surface to the visible outcome. Because of that rigorous lead gatekeeping, the strategic pricing pivot, the bulletproof appraisal package, and the seamless municipal coordination, the deal actually closed. The final sale price landed at $765,000. That breaks down to $76,500 per unit, executing at a really attractive 8.03% capitalization rate. I mean, let that 8.03% cap rate sink in for just a second. That number is the direct result of all the rigorous behind-the-scenes grinding we just explored. Thanks to all that, the seller was able to confidently exit this legacy asset and redeploy their capital into larger, newer properties, totally unburdened by the friction of the transaction itself. So I want to leave you with this final thought. Whenever we're looking at a successful outcome, whether that's a real estate transaction, a big business acquisition, or really any major project, we are usually only seeing the tip of the iceberg. The real tangible value is almost always created down in the depths, in the unglamorous, highly strategic work of risk mitigation and problem solving. So as you look at your own ventures right now, especially in this kind of challenging economic environment, you have to ask yourself, who is managing your invisible work? Thanks so much for joining me for this explainer, and keep learning.